Okay, I think we're live. Good morning, everyone. Happy Tuesday. This is my weekly morning session, coffee with Scott, and I try to bring some value to you each week. I kind of announced in advance, which I don't always do, what we're going to talk about today, and that's seller financing. So we're going to go through some different things about seller financing. And so just kind of give you an idea of what prompted this. And trust me, as long as I've been in the business, I've never done a seller financing deal when I was doing real estate. So I never did one. And we've never really had much call for it. But interesting is that in the last week and a half, had 3 deals that I've helped agents with that were all seller financing. So I'm like, okay, well, it's sort of a mystery, and I thought it would be a good subject to talk about. First and foremost, how to fill out the contract properly, what your role is, what your resources are, what resources you can provide your customers, and then kind of get a grip on at least a little bit of knowledge of is it something they should do or not do. I would first and foremost, advise a customer they shouldn't try to be a lender. It's not really the best thing to do. If they do, they're taking a risk, obviously. But I also did something else. I created I used a spreadsheet, and I created a comparison if they kept the property for 30 years and use it as a rental property versus selling the property with seller financing and financing it for 30 years. The math will show itself, but I'm going to share my screen. Just one moment. And we're going to go through the contract. Everybody can see my screen. Okay, anyone?
No.
I see a frozen Zoom screen. There we go.
See that? Do you see that? Okay.
Yeah.
That's
No.
okay. How about this?
Yep.
Okay. Let's put that down there. So I made some documents actually since I decided to do this course, and I'm going to tell you that they're in Ask Lexi, and I'll pull them up if you want. But I thought that would be good to know why a seller might choose to do seller financing and why a buyer may opt to try to buy a property using seller financing. Just a few bullet points. So seller financing advantages for sellers. Obviously there's, they could close faster, right? Because they're not gonna have the same stringent requirements of pre-approval and all that stuff, underwriting and all those things that a traditional lender would have, right? So they could close faster. They would be relieved from ownership expenses, obviously, such as property taxes, homeowners insurance, and ongoing maintenance. In doing a little research, there's a potential that they might, they may start out being the mortgage lender, but then maybe they're not interested in continuing that. There are investors out there that might buy that note depending on the terms. It's important that the seller make sure they are, of such where they would attract that opportunity, so somebody else could actually want to buy that mortgage. Seller tips, I feel it's important that the seller do some sort of, credit and maybe, income verification to know that they're making a sound or where the risk is and making the decision to choose to do seller financing. And I also feel, and I'm going to show you some numbers it's, at the end of the day, it's probably not the best advice to do a fully amortized loan and basically be the lender for 30 years. Maybe try to do something where you're only doing a 5 or a 10-year balloon. And if you don't know what that is, when we get further into this, I'll explain what a balloon mortgage is versus a fully amortized mortgage. Any questions about that? Okay, seller financing advantages for buyers. They will actually have lower closing costs, right? Because there won't be a loan origination and all these other fees, right, that are tacked on at closing by a traditional lender. So there's a savings there. Obviously, if the seller is accepting a low down payment, then they won't have PMI premiums. So that would be a savings. It's really geared maybe for an option for a buyer that has some credit issues that they can't get traditional financing. So that's where it's a little bit higher risk for a seller to accept seller financing, is because there's typically something potentially wrong with the buyer's ability to get a traditional mortgage from a lender. And this is one of the big ones. They actually are owning something and building equity versus, renting. So most of these buyers will probably are renters right now, and they're trying to buy a home. For them, they should make sure that they can actually afford to make the payments. A lot of times, mortgage payments will end up being less than a rent payment would be. Not necessarily factoring in property insurance and taxes, but overall, it's probably comparable, if not maybe even a little bit less. So there is a monthly payment savings potentially for a buyer to buy versus renting. It would be advisable, and by standard, and I'm going to have Candy speak a little bit because she does the title side, but most of your mortgages won't have a prepayment penalty, but the buyer should make sure that there's no prepayment penalty clause in their mortgage as well. Anybody have any questions so far? None? That makes sense. So it's just a little bit for what it means to a buyer and what it means to a seller. So I'm going to jump over to the sales contract and tell you where you fill out a contract when you're doing seller financing. So we have a financing section right here, and we typically are either selecting A or B. A for cash and B because we're getting a traditional mortgage loan on the property. So actually, instead, you would be selecting D, mortgage to seller. Okay, and it says C, rider C for terms. The other thing that you will be doing is going towards the end of the contract, and you will be selecting C under the addendums here. So there is a standardized addendum to the contract that will be used. So everybody follow me so far?
Yeah, Scott, can the seller only finance if they own the home outright? If they have their own mortgage and they're selling?
If they would have to get an approval from their lender. I don't think that's a very probable thing. So
okay.
The mortgage has to be assumable.
Okay, so
the mortgage has to be assumable and the lender has to approve it. If it's not assumable, then you have to get that lender's approval. But if Scott wants to give me a loan, then I can even if he's not involved in the transaction, we can still prepare a mortgage in the same sense that you would do a seller financing. Just throwing that out there.
So assumable is different than what I'm talking about.
Correct.
Up here to the finance section, right here, right there. So if your seller has an assumable mortgage, meaning that based on the buyer's qualifications, they can actually take over a mortgage, then the bank still becomes that mortgage holder, but you would select C and use rider D instead. So that's a different topic than what we're really talking about. But to answer, I think your question, if the owner doesn't, has a mortgage on it, I don't think it's probable that they would get an approval from the lender to have another mortgage or be the mortgage holder for a new buyer.
Okay.
It's
Could
not
you-
impossible, but I don't think it's probable.
Scott, could you go back to the top of the page, please? I have
To
a
the
question.
what?
The top of the as-is contract. Where we have the finance. Okay, down a little lower where we have the purchase price and closing. I just want to, no, purchase price and closing, I'm sorry. It's on the, yes, there you go. That portion also needs to be filled out, correct?
Well, yeah, of course. I'm just telling you where the differences are.
Well, I know you say of course, but that has to be filled out and it has to match with section C, correct?
Yeah, so if you put $100,000 that they're gonna finance, then this would say 100,000. Yes,
Yes.
Yeah.
And also, when you're dealing with seller financing, you always have advised us to have people put it in writing. That's still, I found good practice to have people put it in writing. Correct.
put what in writing?
Their offer in writing.
Yeah, you always are gonna make offer with these forms. So this is the contract, and now we'll review the addendum that goes with this. Because that's your written offer,
Yes.
okay?
Okay, thank you.
Any other questions about the contract? Pretty simple, that part, right? So the addendum. Addendum C, seller financing. So the first page doesn't really have much to fill in except for initials, and the names of the buyer and the seller and the address of the property. But it has a whole section here on whether or not the seller, so this is really a message to the seller to whether or not they are eligible to be a lender or a mortgage holder. And for almost every opportunity that we have, it's really number one that we're going to deal with, because it's typically going to be the owner of the property and it was their primary residence and now they're moving on, but they're selling their primary residence and they may be the mortgage holder off of that. If they're an investor, it's, maybe number two will be applicable, but not likely. So let's look at this, because this is sort of the important part. So this has nothing to do with the buyer, it's only the seller. So one property exclusion. So in other words, let's just kind of back up. What does this mean? Dodd-Frank, Well, back in the 2010-11 range, we had a collapse in the market, and there was a lot of loans given out with not very high qualifications, and the mortgage market crashed. Well, this representative of the government, Dodd-Frank, he says, you know what, we're going to make some new obligations for getting mortgages. And so this contains whether or not a seller is eligible to be a lender without having a license to be a lender. And so if you look at number one property exclusion, so exclusion from being a licensed lender, where the seller finances only one property in a 12-month period. Okay, the seller owns the property and is a natural person, trust, or an estate, which that's probably any of your customers. The seller did not construct or act as the contractor for construction of residence on the property in an ordinary course of business. In other words, they didn't buy a vacant piece of land and they developed and built a house for the purpose of resale. And so that might be an exclusion. So this might, it's more likely that a property that they just owned, they didn't build it. Financing does not result in a negative amortization, which that's not going to be any of yours. The financing has a fixed or adjustable rate that does not adjust for the first 5 years and is subject to reasonable annual and lifetime rate adjustments, which I'm sure that will, your seller will qualify there. So they would have to, for the first 5 years of the mortgage, they would have to have a fixed rate. And if it's an adjustable, it can't adjust for until after the 5th year. Any questions about that? If you want, you might read this other section. So if you end up with a seller that has multiple properties and they're trying to sell them with seller financing, they may need to look at number 2. If they don't qualify, then they probably can't be a lender or a seller finance. Okay, so when you're working with your buyer and you're making an offer on a property that's going to accept seller financing, you might inquire first verbally with the listing agent to ask if the seller has terms of which they, what's their expectations as far as down payment, interest rate, and things like that. Doesn't mean you can't propose a different amount, different figures to the seller to accept. But I'm sure if you are representing the seller should have a pretty strong idea of what the terms are going to, what they're going to be to even accept seller financing. So if there's a big spread between what the buyer wants to offer for terms and the seller's expectations, the deal may not get put together. But it's not a very difficult document. It says sellers agrees to, at the beginning, seller agrees to hold a note secured by a first or second mortgage. I would not recommend that the seller hold it as a second mortgage. If it is something where that happens, it needs to be relatively small. Where could that fall in a second mortgage? Does anyone know? If, for instance, if the first mortgage lender might have to approve this, but if the first mortgage lender required a certain amount down and the seller or the buyer was short, and the seller wanted to give a second mortgage to the buyer to make up the short so that they have the right down payment, that might be an option. However, the first mortgage lender has to approve it, and likely that's not going to be something that works out because it may put the debt income ratio out. So likely you're never going to deal with a second purchase or a second mortgage by the seller. It's going to be a first. So let's assume that we're going to do first. You're going to check box a first mortgage executed by buyer in principal amount. So then you would put in the amount that the seller is lending the buyer. And so in my Google spreadsheets I'm going to show you, I used a purchase price of $300,000 with 20% down, which means that the mortgage would be how much? It would be $240,000. Then you put the interest rate, the APR interest rate that your seller is going to charge. I'm going to talk a little bit about that coming up to say, well, how much interest should somebody charge? How much interest should a seller charge? It is my professional opinion that it should be a rate higher than the going rate. Okay, so in the 3 examples that I worked with agents in the last week, 2 of them, the mortgage rate is going to be 10%. So the going rate is right around 7% right now. So 10%. And then you have options A, B, C, or D. A is a full amortized loan for the term of, and you got, and by if left blank 30 years. So that would be if the seller was going to give a full 30-year loan on that property. Okay.
Yeah, it's a good call. Are you on?
Hey Diane, if you can mute. B, an interest-only mortgage loan with the requirements of Dodd-Frank set forth above for the term of blank months and requires monthly, quarterly, and annual or periodic interest payments. So if you don't know what an interest-only mortgage is, simply the only part of the payment that's being paid to the seller is the interest only. The balance of the loan will remain the full amount. Not very common. So C, a balloon mortgage that complies with requirements of Dodd-Frank set forth above, an initially amortized term of blank, if like blank 30 years, permitted for one property exclusion only. So this is probably the most the correct one to do, or the one that would be most recommended, is a balloon mortgage. And you have to assume that in the case where the buyer is utilizing seller financing, it's typically because they have some sort of issue and can't get qualified for regular financing. However, they should be working towards being able to be financed by traditional mortgage lender. And this, by getting a balloon mortgage, the seller doesn't have to ride the mortgage for 30 years, and the buyer can then apply for a traditional mortgage and essentially remortgage the property at a specific time frame based on the balloon terms, which are typically broken down like 5 years or 10 years. Does everyone kind of know what a balloon mortgage is? Okay. So balloon mortgage is a shorter mortgage, even though it's amortized for payment purposes per month over a 30-year period. The full amount is due at a specific time frame of 5 or 10 years. And it could be 3 years. It could be any of those. So this just tells how it's going to be amortized. Adjustable rate mortgage loan for a minimum term with the interest rate adjustments as follows. So this would be where a rate starts at a certain amount and then adjusts to a different amount at a different date. All identified here. So let's say your seller is going to initially give a fairly lucrative rate with no prepayment penalty. So the buyer may be seeking to refinance it before the rate increases. So maybe they start at 8.5%, but then after 3 years, the rate goes to 10.5%. So it kind of puts pressure on the buyer to hopefully seek and straighten out their credit issues and be able to get a new mortgage. That makes sense. And then this section down here will more or less set out the terms of the mortgage. The principal plus interest shall be payable in the event of adjustable rate mortgage initially equal to, and then you set the schedule. So it's almost always going to be a monthly payment. And then you would have to use an amortization calculator to tell what the monthly payments would be. And that would be inserted in the center of that second line. Annual payments of dollar amount each, including interest. And you name when the first payment is due, which should be the first day of following month after ownership. If there's interest that needs to be collected from the date of purchase, so if they purchase it on the 15th through the 31st, the title company will usually collect that, and then the first payment will be due the first of the following month. And Candy can correct me if I'm wrong. So
You can make it due whenever you want it to be due, actually. If you want to be a nice guy and give them some random date. And just throwing it out there, we can do amortization schedules for you guys. We can also prepare the note and mortgages for you. So if they, and this doesn't become a charge to your seller, it becomes a charge to your buyer. It's a doc prep fee of $250. But what that does is your note, your mortgage, your AM schedule, that's all prepared. And then say that you work with these clients on a regular and that they actually have someone who paid them off or something, we can prepare the satisfactions of mortgages, because you want to make sure that, especially with the private loans like this, you want to make sure that those things are taken care of, because a lot of people just think, oh, I paid it off, I don't need to worry about anything else. But you do, you have to worry about getting that satisfaction recorded so that that lien doesn't show up later against the client, and you don't have to chase somebody down 20 years after you paid them off.
So just real quick, that was Candy speaking. Candy with our
Oh, sorry.
we got some new people on, and that's really good. But really good job for us. I think some of us could get testimonial, but and I'm going to ask her to talk a little bit more here, but kind of finish this document. So within this addendum, basically it actually outlines what terms are going to be agreeable. If you read the big paragraph, the purchase money mortgage and mortgage note to the seller shall provide a 30-day grace period in the event of a default if a first mortgage and a 15 grace if a second mortgage. Shall provide the right for repayment in whole or in part without penalty. So it doesn't have they're already agreeing that there's no penalty. Shall permit acceleration in the event of transfer of real estate. So if the buyer who has the mortgage sells the property, the mortgage is accelerated and due on sale. So that's already agreed upon. Shall require all prior liens and encumbrance to be kept in good standing. Shall forbid modifications of or future advances under prior mortgages. Shall require buyer to maintain policies of insurance containing standard mortgage clause covering all improvements located on the real property. Against fire and perils included within the terms, extended coverage endorsements, and such other risks and perils as seller may reasonably require in an amount equal to the highest insurable value. And the mortgage note and security agreement shall be otherwise in form of content required by seller, but seller may only require clauses and coverage customary found in mortgages. Mortgage notes and security agreements generally utilized by state or national banks and other residential lending. I'm letting somebody in, sorry. Lending institutions located in the county where the real property is located. All personal property and leases being conveyed or assigned shall at seller's option be subject to lien of any security agreement evidenced by recorded or filed financing agreements or certificate of title. So that paragraph is big, but basically that's really the terms, other than the number terms, that gives the buyer the privilege to prepay without a penalty. That means that if the buyer sells the property, the mortgage has to be satisfied and paid off at the time of closing. That the buyer is required to have proper insurance on the property to cover its real value. So all of those things are already printed there for you. And by executing this addendum, those terms are agreed upon. Any questions about that?
Scott, I have just a general question. So if somebody is doing seller financing and something happens to the seller, what happens then? Like if this is,
I can answer that.
okay,
I'll let Candy.
This is
answer
Candy.
that.
This is Candy with the Elite Closing Group. So if something happens, it's the same thing that if someone dies on a property. So if there's anyone else on the mortgage with them, like it's husband and wife or two individuals, then it would default to the other individual, depending on how it was labeled as joint tenants. But otherwise, it would go through probate, and one of the heirs would need to release it.
I think she meant the
Okay.
seller passes away.
right.
Yeah,
It would be the seller's heirs that would be the new.
correct. Yeah,
Or whoever their will is to,
Because
Okay.
if it's a homestead, then it's passes outside of probate. Isn't that correct, Candy?
but the mortgager doesn't. If the lender passes away, it doesn't matter if it's the borrower's homestead,
Or the lender?
because
I'm sorry.
the lender, because the seller being the lender, it would default to, like, if it was a spouse on title with them, husband and wife, like Bob and Jane, then if Bob passed away, then it would default to Jane. Otherwise it would go to their heirs. Their children would have to satisfy it, and usually you could see a will or something, the underwriter. It's pretty easy to clear.
It's
believe
just
it
an
or not.
inherited asset is what you're saying.
Yeah, we've done it quite a bit in the past, actually.
Perfect. Any more questions? Okay, a couple more documents that I've created and made available. So if you have the listing and the seller, this is a document that's available to you. So seller financing steps and resources, because they're your ability, you're not a mortgage expert. You're not, your role in the whole thing is help them negotiate what they want. So you have to be very careful, because your expertise is not in mortgages. So you need to say, if you want to know more legally about the mortgage side of it, or financially, you need to talk to the lawyer and a tax advisor. But I did make a document that you could share with the seller that kind of gives them, kind of the steps that they should consider taking. So I'll kind of go through this with you. And the first thing it says is consult with a qualified legal advisor and/or tax advisor for guidance. As your real estate agent, we are only able to assist with the negotiation on terms that are acceptable to you. So they need to determine what those terms are. It's safe to tell them that they should be charging an interest rate above the going rate, if for sure. Those sort of things should be stated. I referenced some documents or some links to some websites to learn more about seller financing. I found a really good page that kind of talked both sides of the buyer side and the seller side. So I created a link for someone to go to and kind of learn more on their own. Determine, they need to they should do this in sort of in advance of getting an offer, but they need to determine acceptable terms for seller financing, including but not limited to their APR and a percentage rate, type of loan, balloon or fully amortized, a fixed or adjustable rate, down payment requirements, and then if they're going to be escrowing property taxes and insurance. Probably not something I would advise them to do, but they wouldn't want to learn that the property taxes are not being paid, but it's up to them.
Scott, this is Candy. Usually we put a clause in the mortgage that states that the buyer is responsible to pay the taxes or the seller can foreclose on them. The same thing with the homeowner's insurance.
Okay, so that would be grounds for foreclosure.
If
That's awesome.
you don't pay your taxes, they can take your house.
Yeah. I found, I think it's called calculator, yes, calculator.net amortization. So it's a link so they could actually put in a loan amount, a term amount, how many years, and then a rate, and it'll give them an amortization chart. You'll probably want to use it to fill in the form to, once you base what the monthly payments are going to be, those have to be on that addendum. Next, require the buyer to submit some sort of basic information to check their credit worthiness and their ability to afford the mortgage. Enclosed with this document, what I did, and just so you know, I took what we use for our property management side, basically an information form that a tenant would fill out to apply for to a landlord to get approved for renting a property, and I scaled it back just for the purpose to give enough information for the seller maybe to feel comfortable with giving a mortgage to a buyer. They should do a credit and background check to confirm their comfort and acceptance of agreement. Also, I referenced a couple different websites that would do those services as well, so that they would have some place to go. And then consult the closing title company to verify that for an additional fee, create and prepare a promissory note that includes the terms and conditions agreed between you as the seller and the buyer. If the closing company does not provide this service, you will need a real estate attorney to create and prepare a promissory mortgage. Great thing is, if you're using Elite Closing, you will have that service provided by the title company. Then if you will be escrowing property taxes and insurance, be sure you set up a dedicated banking account solely for the purpose. Each month, you'll be required to deposit escrow amounts to this account and pay out property taxes and insurance each year. So that's a good informational document to give them the steps. And then this is the form. So this is the kind of information they might want to gather from the prospective buyer. And then this information would be enough to be able to go online and use one of those background check companies to, make sure they feel comfortable with lending to that particular, Any questions about this? I hear none. I am going to, just a moment here.
That form's in ask in the back end now, or it will be.
It is.
Okay.
Yeah, so if you go to Ask Lexi, there is a couple more. Just do
Scott, I got a general question. So
Nancy.
I have a few, we had a couple of houses that are on the market, and when I have these, it seems like investors calling about doing something like this, but it seems very, very scamish. Like I've gotten one where they gave me like 6 different choices of what they can do. And the last choice was cash for like 100 grand less than what the house is on the market for. So I just didn't know if you've heard of any scams that are going around with this type of sale.
I can't answer. I think, if you're choosing a reliable title company that's preparing everything,
You're gonna get those lien searches and title searches and everything,
Yeah.
clearing your stuff. Yeah.
So, The other thing about seller financing, one of the benefits, and I don't know if it was listed in the advantages, but the seller should be able to stand strong on the sale price. So whatever, if they're putting their home out there for 300,000, they should get relatively a $300,000 offer by, giving seller financing. So it helps
Yeah,
us.
they're going with the concept of at the end of it, rather than you getting, let's say, 245,000 for your house, you're really getting 325,000. That's kind of their aspect of how they're looking at it. And I don't know if they're just trying to get it into a contract like that and then fix it
So
up,
they're
sell
making,
it, and balloon
let me-
payment out to you.
okay, so they're trying to buy the property and asking the seller to seller finance it.
Yeah. But it seems like investors, more like they're going to either rent it or they're going to
Well, that's
maybe resell it.
well, that's true. So of course, an investor would love to try to get leverage seller's money in the purchase. There's nothing wrong with that. Um, they should be making their payments. They know they would lose it to foreclosure, but investors don't like to use their own money.
This question is for Candy. Candy, what's the cost to prepare a promissory note? What kind of cost is involved with that?
You're on mute.
I'm not.
No, Candy.
I'm on mute. Sorry, I'm talking away.
Oh.
250 is the cost for the preparation, doc preparation fee. And that's again paid by the buyer, and the regular recording charges that you would see on any mortgage, but it's going to be a lot less because there's not 25 pages to this mortgage. It's only 6 pages generally. And the promissory note comes with it. We don't generally record those because then that's putting too much of the client's information on the internet.
Okay, thank you.
You're welcome. Oh, and we do the AM schedules too, the AM schedules. So if you guys can't figure out how to do it, you can call me and I can do it in 2 seconds.
Thank you.
You're welcome.
So again, if you go to Ask Lexi and just type in seller financing, all these forms are here. There's 2 additional forms. They're more or less disclosures to your potential customer that sort of tells them that you're not qualified to give advice whether or not they should either accept seller financing or buy a home with seller financing. They need to make their own intelligent decision, and they should seek the advice of an attorney and a tax advisor in doing so. So that you're not liable because you are not an expert at this. Your job is to negotiate terms that they feel that they're acceptable to them, and you'll be happy to do that. And then take them through the process of finalizing the purchase.
Scott, this might be a silly question, but when you're saying attorneys, because we don't deal with them a lot here in Florida, I'm assuming they'd keep taking a real estate attorney specifically?
Yeah, I think real estate attorney would be the best choice.
Okay.
There's attorneys that kind of cross over into different segments, but not, a real estate attorney would probably be the best advice. Any other questions? Okay, so I'm going to pull up a spreadsheet that I created. Everyone see this? And so I took, actually, I've got a link in here to the link that's on that one page that you give and tells the steps the seller needs to take to an amortization schedule. So here it is. So it's really simple online. You can actually put in the loan amount, the term for 30 years, the rate. So if I do 7%, calculate, it gave me a monthly payment. It would told me how much interest I will pay over a 30-year period. And then down here's amortization schedule by month or by year. So I used this tool to create this information. So over here, I took a home and used an example that it is selling for 300,000 and the seller is putting 20% down. They're charging the buyer 7% rate, so their monthly payment would be $1,597.
Okay.
And so the interest per year, so at year 5, I have out here that they would have paid $81,721 in interest within the first 5 years of that loan. So if you consider a 5-year balloon at 7%, the total return to the seller is the $300,000 for selling the property plus $81,721 for loaning out $240,000. And then I also did this at 10 years. So the interest rate or the interest over 10 years will be $157,560. So the total return to the seller by keeping a loan out for 10 years would be the initial sale plus the interest, which would
Wow.
$57,560. Over to the right of that, I created a chart so I could put in, so when I looked at this 2 days ago, the going interest rate for a 30-year loan was 6.9 something, so roughly 7%. And I feel that if a seller is selling or taking a seller finance, they should consider doing some sort of multiplier for how much they're going to charge for interest. So obviously the more money that the seller or the buyer puts into the property down payment, the safer or the less risk to the seller that the buyer is going to default and lose that money. So at 20% or more, I would consider something like a 1.25 multiplier. So if today's rate is 7%, then maybe offer something like an 8.75% interest. If they're only putting 5% to 19.99%, do a 1.5 multiplier. So that would give it a 10.5% interest rate. So like I said, the ones that I worked on with our agents this week, 2 of them were at 10%. And if they're putting less than 5%, that's huge risk to the seller. So maybe a 1.75 multiplier, which would put the interest rate at 12.25%. Realize that, at 12.25%, if it's a lower income person, they may not, have the ability to afford that mortgage payment with the interest. So that's something that the, seller should investigate before they accept a deal. If you go all the way down to a fully 30 years, if they carry out the mortgage for 30 years, the interest would be $334,820 on a $300,000 purchase. So the total amount of money that the seller would get from the sale of that home over by carrying a mortgage for 30 years on the amount of $240,000 would be $634,820. When you look at an amortization schedule, you'll see that the interest is high in the beginning, but you get down to year 20 and about half of the payment is interest and half of it is principal now. So it's not as not as much of an advantage to the seller in later years of that mortgage. Anybody have any questions about this? Make sense? Okay. Last part of this, I thought it was really cool to take a comparable deal and this is why I feel it's not advantage to the seller to do a fully amortized mortgage. because I took the same property for 300,000 and they kept the property and put a tenant in there over 30 years. Over the course of the ownership, they would probably put a roof on it at least once. They may change a couple of appliances. They put a new AC in it. So they'll spend approximately 20% more on that property to maintain it. And over the course of that ownership, they'll probably put about $150,000 in taxes and insurance payments. So they'll have a total investment of 510,000. But the value of the property, and I used a conservative number, by the way. I looked at what over the last 100 years, and the average was 4% increase on an annual basis. But since 1963, it's 5.8%, but I only used 4%. So I used conservative numbers, but in 30 years, that property would be worth almost 800,000. And they would have, by keeping it, would have about 510,000 in it. They would gain a value of 277,000. And then I took the rents. So the rent would approximately be for the first year, $28,800 in income. But as you go forward at an average increase of 4% a year, the payments obviously go up. And the total payments over 30 years of rents, and I took a 10% adjustment down for vacancy, you know, approximately 1 month per year it might be vacant. It was $1,386,000. Okay. And where you see a big deal is if I look, and like I said, if I look at year 20 here, just as a rental income, by that time, that tenant will probably be paying around $50,000 in rents for that year. Compared to self-financing on the 20th year, you're only collecting under 10,000 in interest. So it makes a lot more sense if the ability for the seller to keep the property. I know that doesn't mean you sell a home, but it just makes it more concrete reason why sellers should choose to do a balloon mortgage and not a fully amortized mortgage. It won't make financial sense over the full course of it. Now, obviously, everything depends on the circumstances of what the seller needs to do for whatever reasons as well.
Would you offer the spreadsheet to your seller or your buyer,
To
your customer?
I don't think so. Well, I mean, I guess you could. I don't see any real problem with it, no.
And is this also posted on the back end?
No, this is just something I did. And you know, obviously, you're talking your seller out of selling their property. If they're gonna, the first thing is, it's not a really good idea for sellers to do financing. They're not, you know, they're not geared to be lenders. It should be almost a last.
Paying $4,000 a month for rent.
Yeah, well, that's 20 years from now. So it's sort of a last resort, and they have to make sure they feel safe that it's a good move for them. You know, you have to realize it at a low rate. You know, rates have been historic lows. A year ago, you know, there were 3.5%. That doesn't even equate to inflation. Everything has went up astronomically more than what the rate, you know, somebody's locked in for 30 years at 3.5% or 3%. They're actually making money by having a loan versus, as long as they're doing good investments, they're actually coming out ahead, so. Any questions? Did I boggle your mind? Did you capture some information here? So
Who's our expert at FLR on this?
what kind of information would you be looking for?
Well, in other words, if this should, somebody, if I found myself in this situation where a seller wanted to finance, like, other than Candy, like, do we have?
I
a
mean, you
go-
can ask me. That's
Okay.
what I do.
Well, you had mentioned before that you had 3 realtors in the last week, and I'm just wondering, how they made it through and.
I have-
And
I assisted them. That's what.
okay, gotcha.
Okay. Filling out the contract and things like that. So, but it's not that difficult. So you just check the correct box, which is, I think, C instead of A or B for finance. Check box, the last page of the contract where the addendums are, C, add the addendum. Remember, the first page of those clauses are really whether or not the seller is qualified to be a lender, which in almost every case, it's fine if it's only one property. That they can, they can do negative amortization. They can do a balloon, which is very advisable if the seller is going to do seller financing, they should do a balloon. They should be charging the premium rate, depending on how much down, the lower the risk. If you wanted a copy of the spreadsheet, I'd be happy to share it with you. Just message me. It calculates. So if you put in, if today's rate goes up to 8%, it changes all these for you and tells you what the variables would be. So you're not likely going to follow, end up doing any of these. Most of you won't do single one of them. But when I have 3 in 1 week and I haven't had any in the history of the company, it tells me something, that there's, I guess, a bigger demand for it. So I felt it was good to cover it.
Well, one thing it might tell us is this. I was looking at a property tax increase, not only on my own property, but on a customer's property. And the property tax, the payments on the homes right now are just, they've gone up. I had someone ask me, have you looked at what the payment is on a $300,000 home right now? And I just wonder, I mean, I'm asking this question here, but maybe I shouldn't. I'm just wondering where we're headed.
Well, I mean, it's just everything is more expensive. When you sell a home, the county gets to readjust the taxes, right? So when you own the home, you're basically protected. However, being a second home, you're not. So it's only your primary residence that you're protected with the homestead. So
I
if
guess often when you
that goes
own
away, you're going to be paying higher taxes.
I guess often when you own a home free and clear, as in these situations, there may be a larger tax increase because to own a home free and clear, you may have been in it for a while.
Mhm.
Yeah. Just a comment. It was just a comment.
Yeah. Well, just know this. If I have if I'm the seller and I have a home worth 300,000, I'm not going to fully amortize a loan to a buyer. I'm going to keep the property and put a tenant in there because I'm going to be much more wealthy in 30 years, 3 times more wealthy. And I still own the home. So, and think about it. an investment point of view. So any other questions or comments?
I have a question. So I guess what I'm trying to understand, and maybe I'm missing an obvious point.
Mhm.
As you said, the sellers, they're not lenders, they're not mortgage, people, but why would somebody need to do, to me, it looks like I need to do seller financing because I can't get approved for a loan. So why would a seller take that risk on that buyer? If the buyer is not able to get a loan through traditional avenues, wouldn't they be considered a high risk?
They're going to be a higher risk. That's why you're going to charge a higher interest rate. But if you're going to get the full sales price for your home and maybe you've been living in your new home for a while and you're just banging to get that thing under contract,
Okay,
you're willing to take the risk.
okay,
So that's what we're finding, that the sellers are accepting it. They're willing to take the risk, but you're going to do it. So it's to your, it's still to your advantage. I probably wouldn't personally do anything with less than 10% down or something, because if the buyer defaults, then there's an expense to foreclose. I'm not sure the amount is going to cost, but it's going to be a few $1,000s to foreclose on the buyer. Plus you hope they don't damage the property and all that craziness, but so no, it's sort of a last resort to me, that the seller would be a lending institution. But they will consider it based on terms that they can accept. But it is a higher risk, because the reason why that buyer, the should be reason why the buyer is using seller financing is because they can't get a traditional loan.
Are the payments being reported to the credit bureaus? I mean, are you still considered a homeowner if you're doing this kind of financing?
Are you still considered a homeowner?
In
Yeah,
other words, credit wise, is it helping to build your credit by making these payments to a seller finance?
I don't know the process to have them recorded so that they're showing on your credit report. I'm sure there is a process, and maybe that's something a buyer would ask a seller to do for them if they're trying to improve their credit. There's probably a process behind that I'm not familiar with.
Okay.
But the ultimate thing, and the reason why a balloon payment, is because you want to kind of force the buyer to clean up what their problem is and get a different mortgage and get me out of it. But when you look at this, see where the interest is. The first year, $16,000 versus $2,000 in principal. So it is certainly in the favor of the seller in the beginning of the loan period, because the majority of that payment is interest. So it's a safer bet. But once you get into the life of that loan, you get into 18, 19, 20 years into it, it's not. Because half of the money's going towards principal and half is interest. So it's not. So it is favorable in the beginning at the right rate. Any other questions?
This is interesting, but honestly, I hope I never have to deal
You
with
never do
something
one?
like this.
Okay.
I don't want to call you for help on this one.
Yeah, no problem. Anyways, you got a good, hopefully a stronger understanding of it and how it works. If you want this spreadsheet, I can share a copy in Google Drive, but you need to ask me for it. So send me an email or a text or something and I'll send it to you. This is based only on 7%. This does not adjust when you change something on here. I used only 7% in here. I probably used 8.25. I used 7% because I cut and pasted it off of this this amortization schedule on this. And there was no other questions or anything, and then we'll end it there. I know it wasn't the funnest class, but it was good education, right? So anything else?
Yeah, this was really good information. Thank you. I genuinely learned a lot just from this, so I appreciate it.
Thank you. Okay, we'll leave it there. I appreciate everyone that joined me today, and hopefully